I'm Debra from the Property Frontline.
Hi, I'm Ken from Avvora Finance.
And I'm Gilmovich from Real Property Manager, and welcome back to Property Mythbusters 2022. We're here to basically bust some myths around the property investing and buying landscape and debunk some of the confusion, contradictory information, and of course, give you a clear path in your property buying initiatives. So welcome back today. Okay, so let's take a look at the rental market and what it could look like in 2022, 2 years on from, of course, the pandemic and the change of market that we've had. What's in store for 2022? Well, let's go back to the previous year, 2021. And there's a graph there indicating the fluctuations that we had, during 2021 across our capital cities, with increases in vacancy rate across the capital cities, and of course that taking the majority of the 2020-21 year, where we had quite a lot of vacancy with a particular property types, and mainly these were the strata apartments, where we were in oversupply. So that had an adverse effect on the rental prices, and we basically peaked around just over 5%, over 4 or 5% in our vacancy rates across all capital cities, but that didn't happen so much in the regional areas, and we'll have a look at that in a sec. When we talk about vacancy rates, we are talking an equilibrium or a little bit over the tipping point of supply when we hit 3%. So 3% is kind of the magic figure when we're looking at investing in a property that we're going to rent out. What the indicating factor to determine whether this is going to be high risk for us on the cash flow, because of course we don't want a vacant property for weeks and weeks and weeks affecting our cash flow. The figure we need to monitor is the vacancy rate, and it starts becoming a red flag when it's hitting 3% and over. That's when supply is exceeding demand, and as you can see in our capital cities, we were reaching vacancy rates last year, hovering around that 3% and over mark. But the indicators are a lot better than 2020 when first the pandemic hit us, of which we went into double digits in most capital cities and our CBDs, such as Sydney, hitting 17% vacancy rate, which was just unprecedented. So as you can see, the highest vacancy rates in 2021 were across, the Sydney and Melbourne markets. Of course, that's the most saturated markets with strata apartments. Even our very own hometown of Canada Bay as well came up as number 9 in the top 10 of vacant properties. Canada Bay, of course, saturates into Rhodes, the suburb of Rhodes, and of course many high-rise apartments still getting built there, and of course established high-rises, they're competing with landlords, are competing on rental prices, forcing the rents and the vacancies to go in an upward direction. So 2022, Canberra, Sydney and Melbourne. Well, we are still in Sydney in particular hovering around that 3.2%, 2.6%, 3.2% for Melbourne, and down the east coast there of Canberra at 1%, a lot more healthier. But yes, we're still kind of at that point, just under 3% and 3.2%, particularly the CBDs of Sydney and Melbourne, still in a bit of oversupply, still very volatile in the strata on the apartment side. And as you can see there, not so much in Brisbane, 1.2%, that's pretty healthy. Perth just under 1%, and Darwin under 1% as well. And that's as a result of that migration we've had internally between states of people leaving the CBDs in the capital cities and moving out further out for affordability, a better deal, and of course, lifestyle change, which has occurred in the last couple of years. It's still, around the 3%. It's still a bit of a tenants market, and there's still negotiations going on the rental front from tenants. So anything below 3% really is a landlord's market. Anything 3 and above is going to be a tenants controlled market. So what's in store for 2022? Well, the interesting thing that's happened is the disparity between strata apartments and houses. And what's occurred is that the houses have become really, really popular because of the need for more space. Most of the 2 bedrooms, most of the strata apartments that got built around Sydney and Melbourne were pretty much generic 2-bedroom, 1 or 2 bathrooms and the car space. And with lockdowns, with potentially both sets of parents working from home during those periods, and of course, some not going back, schools being out and the kids being at home getting homeschooled, the big thing at the present moment is space, more room, more bedrooms to utilise as home offices, and also, potentially teaching the kids from home remote learning. So the houses, even townhouses, crucially in demand, and that's placed the houses in a really, really good position where rents haven't really fallen, slight adjustments haven't really fallen, and rents started to move in an upward trajectory because that's the scarce dwelling. Okay, so it's not the apartments, the houses, they're not getting built anymore, and they're undersupplied in the major capital cities, and tenants do want them. So we are predicting at the moment that the house rents will continue to be strong throughout 2022 and possibly beyond. And with the apartments, we do see a comeback for the apartments. It's not all doom and gloom. And this will all kind of tie in with the immigration numbers, students coming back, the gates opening up, to skilled workers coming back in. That's going to be the return of the yields for the apartments. And we're starting to already see that early this year. It's only February, but we're starting to see very strong demand for inner city apartments, multiple applications going on as people come back, or their employers demand them to come back to the office, even if it's 2 to 3 days a week. And general demand, we're starting to see vacancy rates tumble down under 3%. And I think throughout 2022, this is likely to continue, and we will see the return of rental increases. That's no doubt that's going to happen, but it's going to be a slow trickle through, especially on the apartments. So good news for property investors. The rents are starting to return back to normal. We're going to see some increases going on this year in certain pockets of the capital cities. So as a summary, we do see rents increasing strongly. It's just a matter of time. We will see vacancy rates tumble, and that'll tie into international borders opening up. As we know, government started to ease restrictions, and definitely we'll see migration coming back this year. If we think about it there, people need to rent before they buy. So when the migrants are coming in, they will generally go onto the rental market first before they jump into purchasing. So there will be that demand
Can I just
as
ask
well.
Can I ask a question, John, in relation
Absolutely.
to the rental returns? Have you experienced personally tenants negotiating a really low rent for a longer period? So those people that, agreed to a rental in, say, October, they have to wait 12 months before they can change, renew their tenants and get a better rate? You seen any changes in duration like that?
Okay, so if the question's around are tenants asking for longer leases, is that where you're coming from?
It is, did landlords agree to long leases at a lower rent in, say, October 2021? And
Okay,
so
last year.
Yeah. So they're going to be...
The answer is no, they didn't. And most were holding back from locking into anything beyond 12 months. That was on the basis that, the pandemic's not going to last forever, lockdown's not going to last forever. They are confident that the markets will return, as they are starting to see that right now. And the answer was no, they were not prepared to lock into anything beyond 12
good.
months. So that's kind of where it sits now, and it's on the proviso that they were happy to give the discount at the time because the market was very volatile, and they didn't want a vacancy and be forced into a situation where their property could have been vacant for weeks and weeks and weeks, and then they're competing with all the others that are on the market, forcing the rent down further. So they took what was given to them, 1/3 in the hand, but at the same time didn't want to overcommit themselves into long leases and not be able to adjust the rent at some point of time.
Okay, well that's...
So we're still seeing those kind of 12 months blocks of leases being negotiated. Nothing really beyond that, Deborah.
All right, sounds good.
So a lot's going to ride on the fact that international students, our skilled workers, and migration will come back into some normality, and that's going to be really, really key how fast the rents drive forward.
Lovely.
So what I might do is just in terms of looking ahead to what the home loan market looks like in the coming year. Just probably recap some of the stuff that's happened last year, because I think they will all kind of contribute to what is expected to happen. So one of the things that the regulators have done last year was increase the buffer rate. So lenders had increased the amount that they assessed the home loans by 0.5%. It didn't make a material difference from the types of clients and applications that I was seeing at this time. But later on, it could kind of curb the amount of borrowing capacity people have to make a purchase. The other thing was, because interest rates were so low, DTI, or debt to income ratio, a lot of lenders wouldn't lend more than 6 times a person's income. So this is including their salary, rental income, any other form of income, business income, to then determine how much you could service. So that did impact some clients, but there are lenders now who are willing to go up to even 8, or some don't even look at DTI, debt to income ratio. So that's something to consider if you are looking at properties, and probably more so for investors, from what I understand. So there are investors coming into the market, from what I can tell now, and when you've got quite a bit of debt, mainly negatively geared properties, you've got your rental income, but the debt's significantly not making repayments. You'll probably run into these DTI kind of caps, which would restrict the lending. The other thing is with interest rates, so the fixed rates have generally been increasing. I can't say so for the 1 year, but anything more than that, so 2, 3, and 5 years, they have increased, and they have been for the last, I don't know, 3, 4 months or so. So that can have an impact on people's borrowing capacity, because the interest rates are higher, and then you add the buffer rate on top of that to determine what your borrowing capacity is. The variable rates have been decreasing, and they're kind of on par with where the fixed rates are at the moment with the 1 year. So that's something to consider. There were issues with the amount of applications. So certain lenders are still struggling with turnaround times. Not so much the majors at the moment, but the smaller lenders. This could be because, you know, people are becoming a little bit adventurous and have a bit more risk appetite to kind of look at other lenders. It was interesting to see that the major four were the primary lenders that applicants were looking at during a time of uncertainty. So that uncertainty seems to have come off, and the smaller lenders are starting to are now picking up a lot of the applications from what I can see. So moving forward, I guess into the year, it could be interesting if there are any rate increases and how that will kind of affect people's plans to purchase. It seems like there have been a lot of plans to purchase this year as well. So from my point of view, in terms of applications for home loans, the demand hasn't really dropped off. It's settled down a little bit, but it's still strong. So whether that kind of still flows into the property market is yet to see. And I don't know if the regulators will step in to take more action to try and curb lending. That's it in a nutshell from the home loan side of things.
Okay, sounds good. Alrighty, so I'm just going to share my screen, hopefully. Like the two of you, I'll just do a little bit of a recap. 2021, obviously, the big headline was that the national property values are Australia-wide around 22%. But of course, we have to remember that we've got well over 15,000 suburbs, and within each suburb, you know, different markets perform differently. But at the overarching message was that property just really outperformed last year. And I thought that other interesting statistic, which John mentioned, was that over the 12 months to June 2021 from the ABS, around about 80,000 people left Victoria, and Queensland gained the majority of them. So a lot of people literally picked up and moved to Queensland. So it'll be interesting to see how many of those people experience a really, really hot summer, their very first, over, you know, this current summer, and whether at the end of it they go, oh wow, this is really too hot for us to handle, and whether they all end up going back to Victoria. Of course, we're not expecting all of them to do it, but I think there will be at least, you'd have to say, 25 to 35% of people who moved can't handle it. And of course, that had a massive impact on the property pricing in Queensland. It was crazy buying. Week on week, I would be looking at the same kind of price brackets to purchase in, and at every level you would go back week on week and you'd be up like 5 to 10, sometimes 20,000 in expectations. It was ridiculous. But anyway, we cope with it. So what I wanted to talk about was, what are the roadblocks for 2022? So things that might snag the market. Of course, Ken mentioned interest rate rises. We aren't expecting, and the RBA said they're not going to do anything until the federal election, which will be in May. But then after that, we can expect a little bit of movement. How much of an impact will that have on buying capacity or confidence? Really, I don't expect it to have too much, because so many people, it has been reported, are ahead with their repayments. So I think the market is still strong enough to handle a few rate increases. The other roadblock is the federal election. We still, at this point, do not know, because the policies haven't really been released yet. We do not know what the Liberal or the Labor governments are planning, and whether they'll have any massive policies like Labor had with getting rid of negative gearing. I mean, that had a massive impact on the market in 2019, as re-elected the Liberal government. We have to wait and see as to what those policies might be. So I will be digging around to try and get those. The other roadblocks that we're starting to see are state-based tax changes. So Queensland has recently announced that they will be changing their land tax legislation, which will make it more expensive for people to hold a portfolio of properties in Queensland. And goodness knows if that's successful, then we might see other states doing the same. Victoria has been doing some really weird things for quite some time, so have introduced some, like success taxes. If a new piece of infrastructure comes in and you have a massive increase in your property value, now Victorian government want you to pay quite a substantial amount to them. So those are the things to watch there. And then the other creeping change is property legislation. And I won't go into it, but John, as the president of the New South Wales Property Owners Association, you're right in the hot seat as to what the government is doing there, which might restrict property owners, their ability to actually make as much from their existing property or to even be able to retain their current property. So things to watch. And who knows, like the whole Black Swan event, COVID 2022, even that, like we can't sort of go that far. These are the main things that we can see impacting the market in Australia. So boosters, property market impacts that will keep the market buoyant. Unemployment rate is absolutely hitting historic levels. Will that change now that the borders are opening? I think there's such a huge demand that it's going to take at least 12 months for that to really start to impact. The other booster that will keep the market buoyant is opening up the borders. So we all know, as John mentioned, that with more people coming into the country, we'll expect the property market to stay robust. The next point, there is still really, really limited supply. So there's still many more buyers than there are sellers right across Australia in most markets. Well, I am starting to see, though, in Sydney, properties that have a few issues that are difficult to deal with. They're not getting as much attention as properties that are either in that really good high level standard, so properties that are already renovated. But properties on busy roads, it's always an indicator of where the market's heading. Properties on busy roads are starting to have less appeal, and so if you have some of those sorts of properties in your portfolio, best to get them on the market now, because I think the window for getting a decent price for those properties is closing. And the final point I've got, so the boomers, so those people who have long ownership in the cities of their properties, will we start to see more of those houses coming onto the market? I still think it is still a bit of a trickle, but in the next 10 weeks, in the lead up to Easter, we will start to see a little bit more supply. So what else is happening? Auction rates across the country still very, very high. And most market forecasters still have generally our cities and major regions in that 5 to 10% on the increase. So that's it for me. So anything else we would want to add? No? Okay. All righty.
No, we're all good.
Okay, so thanks very much for watching. We'd love to hear your feedback. You can reach all of us on our own sites. So you can find Ken at avvora.com.au, John at realpropertymanager.com.au, and me at propertyfrontline.com.au. Until next time, bye-bye.